The short-term technicals, guys, are significantly overbought. This is the RSI down here below, guys. Whenever the market hits a 77 reading on the RSI, on the 1-hour chart, we tend to get a pullback. We tend to get pullbacks after every single time we hit this overbought reading. These pullbacks, guys, usually range from about 1% and 1.5%. Okay, that means anywhere between $4 to $6 to $7 in terms of a pullback. Now, interestingly, I did point out in the last video, guys, if you remember, that I had a target of 451.5. We hit that perfectly yesterday. 451.5 to hit these prior highs and these prior swing lows. This is a key pivot zone. Look at how many times we hit this exact same level. 1, 2, 3, 4, 5, 6 times. Whenever we're below a pivot zone, it will act as resistance. Whenever we're above that pivot zone, it will act as support. So we're now below that pivot zone. We are overbought in the short term on the RSI. We're heading into a key event and the market has already rallied significantly ahead of the event. So the most likely outcome, in my humble opinion, is a pullback. Initially, we get something like a small rally to 452.5, potentially 453, and then we pull back down to 445. That will now act as significant support because it is another key pivot zone that we discussed. So I'm looking for potentially a small rally, but because the market is significantly overbought in the short term, we expect that rally to produce a pullback to 445 and for buyers to step in at 445. Welcome back, you legends. I'm Dr. Cal. Let's get right into this weekend update video. Good news, legends. You did not miss anything from my last video 10 days ago because everything that we were looking for actually happened pretty much exactly the way we expected it to happen. So let's jump right into it. Let's start with the stock market map for last week. Notice, legends, Apple, Nvidia, Broadcom, Qualcomm, all of these high-flying tech and semiconductor names gave back a lot of those gains last week. Then we had tech in Microsoft, Oracle, and Fortinet. So we have those key software cybersecurity names doing well. And remember, legends, from my last video, I talked a lot about software names and how yields topping will be a huge tailwind for all of these software names, high growth names, because as yields begin to decline, valuations in these names begin to expand, and the largest, biggest, most inflated valuations in the stock market are in the fastest growing names. These tend to be very high profit, very high margin, fast growing names. These always, nearly always, guys, tend to be software names. What else do we have? Well, we have Eli Lilly. They have that weight loss drug that is getting super close to launching in the market. They're still waiting on the final approval. Then we have energy stocks rallying in the market as a reaction to Russia and Saudi Arabia cutting oil production. We saw oil prices soaring and energy stocks reacted very positively to that. We have a mixed picture here, guys, in financials. Cyclicals, things like Amazon holding up, Tesla slightly down. I would say 3.7% is slightly down, not a major decline like Apple, Nvidia, and all of these semiconductor names, with the exception of Intel, which is seen as a value name. Then we have industrials. Look at this, industrials declining and railroads declining. Now, why do railroads matter? Well, because they're an important component of the Dow Jones Transports Index. And I'll talk about this later in the video. The Transports Index, this beautiful chart right here in the blue and black, represents the Dow Jones Transports. Up top is the Dow Jones Industrials. The transports tend to lead the industrials. I have a lot of these examples that I shared with you in the past, including positive divergences, bearish divergences. These nearly always, guys, lead to turns in the market. As of right now, we have this sizable bullish divergence, or I should say just a divergence between the Dow Jones Transports down below and the Dow Jones Industrials up top. We see that the transports lead the industrials, but they're declining. Why is this a bullish divergence? Why is it not a bearish divergence? Well, I'll put it very simply this way, legends. A bearish divergence means a high going down to a lower high, something that looks like this. Notice, this is a high. It goes up to a higher high in the industrials. Then we have a high right here in the transports that goes up to a lower high. This is a bearish divergence. And as a result, we get this period of weakness. In this example, we just had consolidation, not really a major sell-offs, but just consolidation. Another example of this divergence is right here. Look at this higher high versus this high. While these transports put in a significantly lower high, bearish divergence leads to a sell-off in the market. This is the S&P 500 down below. I put it just to really compare how the market performs when these divergences build up. Now, a bullish divergence is when either one of these, right, either the Dow Jones transports down below or the industrials up top, if either one puts in a low followed by a higher low, whereas the other index puts in a low followed by a lower low, that establishes divergence. So bullish divergences happen when we're looking at lows. Bearish divergences happen or develop when we're looking at highs. That's really the major difference here. And I'll show you exactly what I mean right here, legends. Look at this interesting divergence. Higher lows on the the industrials, equal lows on the transports. We got a bounce. Another example is right over here. Look at this, equal lows, roughly equal lows on the transports, lower low on the industrials. The transports led. This was a bullish divergence. We had a rally. Another example is here, lower lows, equal lows on the transports. The market continued higher. There are a bunch of these examples, including these. Look at this, guys. Higher lows on the industrials, lower lows on the transports, continuation higher. So when there are divergent lows, that is usually bullish. When there are divergent highs, okay, divergent highs, that is usually bearish. Right now, we have divergent lows, which tends to lean more bullish, in my humble opinion. Let's jump right into the daily chart for the S&P 500. My last video was published as the market hit 451 right here on August the 30th. I was off for a week, guys, dealing with some health challenges in the family. You all are aware. So I don't need to repeat that, but we had to go through a lot more stuff last week. But fear not, I'm back, guys. We'll be back with the regular uploads. Boring, God willing, nothing unexpected happening. Okay, so that was it. I talked about the daily chart on the S&P 500. Let me pull it up. Here it is. I talked about this. I talked about that whenever the RSI goes above 77, we tend to have a divergent high and the market tends to get a pullback. Example, Exhibit A, right here. Over 77, divergent high, higher high on the the hourly chart. Lower high on momentum on the RSI. We had a pullback. Another example, a boom right here. Above 77, divergent high, pretty much equal highs, significantly lower high on the RSI, sell-off, or I should say pullback. Another example is right here, guys, over 77, pullback. Now, we hit over 77. We had that divergent high. We hit 453. I was looking for 452.5 to 453 on better than expected PCE. We got better than expected PCE, and we rallied, let's see, all the way to 453.6. to this prior high, to the bottom of this beautiful gap right here. We did not fill the gap. We stopped just at the lower border of the gap. Perfect stoppage, in my opinion. Sell-off ensued, pull back to 445. We got below 445 intraday once, twice, 3 times. We closed above or at 445 pretty much in every single day, every single one of these. Okay, so why is 445 important? Number one. Number two, why were we looking for a pullback to 445? Number three, why were we looking for a slight rally from 451 to 452.5 to 453? I'll explain all of that, but all of that is explained in detail, in real time, in the legendary trading community. Link in the description if you guys are interested to join. I still have that 70% discount up to celebrate the 20,000 subscriber mark. I haven't taken down that discount yet because I was away for about a week. By the way, guys, even when I'm away not uploading videos, I do publish real-time live analysis every single day in the trading community. I also post all of my trades, all of my investments, and every single setup that I'm watching and I'm looking to enter or exit. So legends, the logic is pretty simple. We were looking at 77 on the RSI. We had pullbacks every time in this uptrend. When we hit that level, we hit it. We were looking after that for a slight rally, slight higher high to 453. That's because in my personal expectations, I expected PCE to be in line or to lean slightly bullish. That's precisely what happened. I had that small rally to the upside. In fact, we did gap up. Then we had that sell-off. This was a clear bearish divergence on the RSI on the 1 hour chart. After that happened, we were looking for that pullback to 445, and we got that then slightly lower than that. And so far, guys, price has been finding support at the purple slow moving average. This is a key moving average because in an uptrend, you want to see price hold at this key level, even if we get a slight undercut for a day or two. You want to see price quickly recover and move back up. So far, we have actually held this moving average, which is positive. The stochastic is rising. It produced a bullish cross in oversold territory that marked the bottom exactly. In fact, I talked about this as it happened in the trading community. I published a note saying that this is likely the bottom, and I went through the reasons why. One of those reasons, legends, is the bullish cross in oversold territory. And the other reason is when the RSI dips below 50, comes back to recover the moving average. That usually, guys, marks the end of the pullback. Now, that is all well and good, but what happens next? Well, the market is doing what you would expect it to do ahead of a huge economic drop. That is next week, legends. Here it is. Core PPI Thursday and Wednesday, core CPI and CPI. So we have inflation for consumers coming out. That number is coming out Wednesday, and for producers, that's coming out Thursday. These will be market moving events. Now, for the pullback to end and for the market to begin to push back higher, we need both CPI and PPI to come in line with expectations or slightly below expectations. I think that will be bullish. If they come in higher than expectations, then there's the possibility that we actually could see continuation to the downside before we rally higher. The level that I'm looking at is this, legends, 439.6, 440. Let's just call it 440 to tag this prior support line. That's in case CPI comes in hotter than expected. If it comes in line with expectations or better than expected, this will likely hold at the bottom, and we will continue higher to retest this marginal resistance line. And if you break above it, this will eventually prove to be a bull pennant with breakout. Then you would look for an entry on a back test. That will likely be it, and the market will continue higher from that point on. That's assuming CPI comes in below expectations. Higher than expected, look for a sell-off continuation at least to 440, and then we'll have to reassess from that point on. Now, this is not a clear-cut bottom just yet for one simple reason. Look at it. Boom. This red and green moving average is the 5-day moving average. It is the trend-setting moving average. When we get a close above it, boom, that confirms the bottom. We continue higher. When we get a close above it, boom, that confirms the bottom. We continue higher after a pullback. So far, we did not close above it. It is still declining. So keep in mind, we can still see 2 to 3 days of weakness ahead of CPI. And remember, legends, you want to see the market being bearish, red, ahead of a key event like CPI. If you're bullish, right, it's a contrarian indicator. And if you're bearish, you want to see the market rally ahead of CPI, hit resistance so you can short after CPI. Okay, so this is pretty obvious, legends, what's happening. The market is just taking a pause, waiting for that key data, CPI and PPI next week. If it's hotter than expected, expect more selling, 440. If it's better than expected or in line with expectations, expect this low to hold and for the market to continue higher to around 451. And we'll assess from that point on. If we hit this resistance line, we'll have to reassess. If we hit the support line, we will have to reassess at that point. But so far, this is just a pullback. Look at this RSI parked at 50. Usually, guys, the market finds a bottom at 50 in pullbacks. Let me show you. Let's drop a vertical line so you can, guys, see clearly what's going on. Here it is when we hit below 50. Usually that marks the bottom. Again, boom, marks the bottom. Again, boom marks the bottom, boom marks the bottom. And in this pullback, here it is, drop below 50. We're back above 50. That marked the bottom so far. Okay, what other indicators can we use to actually suss out if this is if the market is leaning more bearish or more bullish? Now, in my opinion, the market is leaning slightly more bullish than bearish for several reasons. Number one, this is a key level, 445, key level resistance twice. Once we broke through it, boom, we had a sell-off, waterfall sell-off, then rejected again, resistance, and now we're back testing it as support. The price held here, held 445. It is now support. So the bulls have 445 as support. If they lose it, expect a sell-off to 440. If they continue to hold it, expect continuation to the upside. So far, the bulls have the slight edge in this perspective. If I take a look at the VIX, key chart to look at is the volatility index. Whenever the market is rallying, the VIX likes to decline. Whenever the market is selling off, the VIX likes to jump up higher. What is important on the VIX? Well, it's very simple. I'll show you exactly what to look for on the VIX. Now, this is the S&P 500 in blue and black. Up top is the VIX, and this is the 50-day moving average, this green line. Why is it important? Well, because it's a very simple but extremely effective technical indicator. What do I mean? What the heck do I mean by that? Well, pretty simple, legends. When the VIX is below the 50, the market is in an uptrend. When the VIX is above the 50, the market is in a downtrend. Pretty simple, right? VIX below 50 entire period here. The VIX was below the 50. The market remained in an uptrend. When we got above it, when we got above the 50, the market had a sell-off. Now, what has happened recently? Well, we were below the 50 and the market was rallying. Look at this perfect correlation. Whenever the VIX is below the 50, the market is rallying. When we got above the 50, the market had that sell-off. Okay, what's been happening more recently? Well, look at this, legends. It's a perfect two tombstone rejection candles right at the 50 and the 20-day moving averages. The VIX tried once, twice, 3 times to close above the 50. It failed all 3 times. Whenever the VIX is below the 50-day moving average, it is extremely difficult to short the market. You do not want to be shorting the rips until the VIX is above the 50. You want to be buying the dips as long as the VIX is below the 50. It's pretty simple. The last 3 trading sessions last week was 1 tombstone candle, 2 tombstone candles, 3 tombstone candles with the closure below the 5-day moving average. We also have a gap here to fill at 13.12. So we should see still some upside with the market leaning more bullish because the VIX is now working against the sellers. It is working against the shorts. The shorts will have a really difficult time shorting the market, and puts will have a really difficult time holding on to their value as long as the VIX is declining. Okay, so we covered the daily chart for the S&P 500. We covered the hourly chart for the S&P 500. Let's now look at targets. Well, we have the RSI rising, stochastic rising, and it's holding above an inclining slow moving average. As long as this moving average is inclining, the market is still in an uptrend. What are the targets that we're looking at? Very short term, we're looking at this gap to get filled at 449.5. That's very short term. Maybe ahead of CPI. We'll see. If CPI again is bullish, we're looking at a continuation of the rally, at least to test this high, and more likely than not to fill this gap at 456.5. So that's my humble opinion. If CPI is bullish, if it comes below expectations or it meets expectations, I expect a continuation higher to 456, slightly higher high. And we will reassess from that point on. If CPI is bearish, expect a continuation down to tag this support line. That means a sell-off to 440. From that point on, we'll have to reassess, and that opens the door for a gap fill all the way down to 431. Remember, guys, we have this gap. This gap is unfilled. It is very obvious on the daily chart. This is the gap. It has not been filled yet. So the market could still do something that looks like this, legends. Fills the gap into late September, potentially into early October. That is still possible. But as of right now, according to the data that we have available to us At the point of recording this, the market is leaning slightly bullish heading into CPI. Now, this daily candle does not look all that exciting, right? It held at the 20-day, that's fine. Then it tried to rally to the 50-day and the 9-day moving averages. It produced a tombstone candle. We don't like these candles. Small body, long a wick to the upside indicates a rejection, a minor rejection, but it's on weak volume. So I'm hesitant to call this a rejection just yet. So far, it does not look like sellers are committed. It just looks like the buyers are not showing commitment. So we're not seeing sellers here. Really, most sellers are sold at the top here. Sellers will really commit or recommit, I should say, once this low is taken. If 443 is taken out, if we get it close below, that almost certainly opens the door lower to that 440 target. As long as this low holds, the bears will have a tough time committing to selling the market here. Okay, what other indicators that could help us, again, suss out if the market is leaning bearish or bullish? So far, we have the RSI holding at 50. We have the 1-hour chart and the VIX all leaning bullish. What else? Let's take a look, legends, at the high yield bond smart money. Is it showing any bullish or bearish divergences? Well, we had that bearish divergence here as the market was making slightly higher highs. The high yield bonds, the smart money, was actually selling. It was making lower highs. That was another sign that the market was ready to pull back. We got that pullback and we got that recovery starting now. No bullish or bearish divergence so far. They're just moving in tandem. So does it help us a lot? Let's take a look at XLY divided by XLP. So consumer discretionary relative to consumer staples. That means high risk assets relative to low risk assets. Whenever the market is bullish, whenever sentiment is bullish, you see high risk outperforming low risk. You see high risk outperforming low risk. So far, we have been in this range. We did develop this bull pennant. We had that breakout of the bull pennant exactly as the market was bottoming, in fact. And then we had that rally in cyclicals, discretionaries relative to defensives like staples. We do have a small rejection candle, but so far, PPO is still positive above the zero line. The histogram still showing green candles. We're still above the 50-day, the 20-day, and the 10-day moving averages. So far, this does look like a bull pennant breakout. We could see a backtest of the pennant. That is still possible. That would actually still be bullish, right? In fact, let's extend it so you guys can see it. Here it is. Breakout here. We could see a backtest that is still possible, and then a rally higher that is still certainly possible, and it would still be bullish in my humble opinion as long as these lows hold. So it should look more like this. What else? Let's take a look at the NASDAQ 100 relative to the S&P 500. Whenever tech is outperforming the market, that's when risk is on. That's when institutional investors are taking on risk, buying the market. And that's pretty much what has been happening. More recently, we had this consolidation / distribution. Look at this. The 50-day has held throughout this bull rally since that bottom in January of this year, right up until we had that high in July. Look at this perfect top, bearish divergence. I discussed this as it was developing. We had that big sell-off in the market right here. This is the market legends, the S&P 500 down here. We had that big sell-off. Since then, we actually held the lows. The market has been making higher lows and slightly higher highs. And the PPO has crossed back up. It is above the zero line. We could still see some more choppiness until we hit the lower border of this channel. That is still possible, heading especially into late September. Now, what does seasonality look like in September? Well, it usually, guys, sees some rallies in September, meager rallies, about 1 to 1.5% in the Russell, the S&P, and the NASDAQ. Then a big sell-off after the 12th trading day. These are the trading days, not the dates, the trading days. So the market tends to top around the 12th to 13th trading days. Then we get a big sell-off into the end of the trading month. So when are the 12th and the 13th trading days? Pretty simple. Let's use our measuring tool. Let's look at the 12th and 13th bar. That means that is September 20th. The market should top based on seasonality around September 20th to September 21st. What do we have around September 20th to September 21st? Well, legends, what do you know? We have, here it is, Fed press conference, the Fed interest rate decision, September 20th. Kind of funny how this works out, right, legends? Kind of funny. September 20th, we have the Fed interest rate decision. So I could see a lot of ways this could play out. I think the most likely scenario is CPI comes in, maybe in line with expectations, not a big surprise to the upside or to the downside. The market tries to rally again, maybe push again higher to this resistance line, maybe slightly higher. Maybe it fills this gap at around September 20th. The Fed comes out, potentially announces another rate hike in September. Then we get a sell-off either to this support line, marginal support line, or to this long-term support line that pretty much tagged all major bottoms this year, including, or I should say, since October of last year, the major bottom of October of last year and the major bottom of the SVB Silicon Valley Bank collapse in March of this year. So I think a major fundamental event needs to happen to allow the market to go all the way back to backtest this to the same trend line. Maybe you go low to 420. That's just too early to tell as of right now. But I think a scenario of a rate hike in September could potentially be the catalyst to this sell-off all the way down to fill the gap at 431 with some more additional potential downside to 420. I'm open to both possibilities at this point in time. Okay, what else do we have that could help us? Up top is gold relative to the S&P 500. Down below here is the S&P 500. Nobody else uses this chart. I've never seen anybody use it. I've been using it because it's been exceptionally good at marking stock market reversals, especially bottoms. What the heck do I mean by that? What am I talking about? Well, pretty simple, legends. When we get a bearish cross on the PPO in the gold to S&P 500 ratio chart, that tells us that smart money has stopped buying gold as a hedge and they're now buying the stock market. They're taking risk. What happens when this signal is triggered? Well, we get rallies. Even in bear markets, we get rallies, we get boom rallies, more rallies, more rallies. So far, legends, since really mid-July, gold has been outperforming the S&P 500, relatively speaking, right up until last week when the histogram tightened very closely and the PPO is about to produce a cross down, indicating that smart money could potentially stop buying gold as a hedge and enter the market to go long. The moving averages are too tight to call this a buy signal just yet. In my opinion, I need to see big histogram red candles that look more like this to be more confident in calling this a buy signal, but it is getting very close. What else am I watching? Well, the Money Time Machine CPC put to call ratio buy and sell signal. What do we have on the CPC? Remember, legends, I talked about this in my last video. I was waiting for a buy signal on the CPC. No buy signal just yet. We're not out of the woods just yet. But I need to point this out. Look at this. 1.1, whenever the CPC rises above 1.1, comes back down below 1.1, with the PPO producing a cross that always triggers a very strong buy signal, exceptionally strong buy signal. Do we have a buy signal just yet? No, but the CPC is now at 1.1 and we're putting in a triple top. Why is it triple top important? Well, look at this. 1, 2, 3, triple top, mark the bottom, had a rally. Again, 1, 2, 3, triple top, mark the bottom, had a rally. Again, legends, this works even in bull markets, full-fledged bull markets. 1, 2, 3, triple top, mark the bottom, the market rallied. 1, 2, 3, triple top, marked the bottom, the market had a rally. So what are we looking for? Well, I'm looking for the CPC to come back down below 1.1 and for the PPO to produce a cross down. That would mean that put buyers are stopping, they're slowing down, and they're beginning to pivot toward what? Toward buying calls, buying calls, buying calls. When does the smart money begin to buy calls? When does the market begin to turn away from puts into calls? When the market is actually bottoming. Now let's talk about the New York Stock Exchange Summation Index. This is the McClellan Volume Summation Index here. Below that is the oscillator. Up top is the S&P. What am I looking for? Well, we had a bullish cross, a green buy signal just after the market bottomed. Here it was. And unfortunately, the market actually came back to produce another cross down. So this is now a whipsaw signal. It is not very useful. And usually, guys, when we get whipsaw signals like this, it's one of two things. Either the market is actually bottoming and we're getting a rally, or two, we're entering a period of a lot and a lot of nothing. Just sideways moves. Look at all of these. Sideways range-bound market, sideways range-bound market. What am I leaning towards? Honestly, quite frankly, I think I'm leaning toward short-term, slightly bullish into mid-October, late October. That's medium-term. I lean more bearish, and I favor something that looks a lot like these structures. Range-bound, choppy, nasty market that really doesn't help anybody, not the bulls, not the bears, nobody. And then in November, we get a nice rally heading into the holiday season that is backed up by seasonality. Look at this, guys. Pre-election year seasonality, we tend to get a double top in September, big sell-off into the end of September, another rally to start October. The first week of October, that is it. Just one rally towards the beginning of October, then another big sell-off and a major bottom by the end of October, then a rally into early November, into late November, early December, into the end of the year. Big rallies, holiday rallies, roughly by the fourth week of November. That's kind of what I'm expecting, something in line with that. Lots of choppy trading, leading slightly bearish, with a major low developing in October, likely either that 431 gap fill or slightly lower to 420. Either one of these I'll be happy with. If we actually just find the bottom at 431, that will be way more bullish in the second half of November and into December. If we go back to 420, that would lean slightly more bearish, just my humble opinion. What about breadth? Well, legends, very interesting. This is the 50-day S&P 500 breadth. And what do we have here? Notice we are at 33.6 and we have a nice little double bottom. Just like this one, just like this one, just like this one, just like this one. What happened in every one of these? The market was actually bottoming, the market was bottoming, the market was bottoming, the market was bottoming. Okay, so what am I looking for? Still short term. Very murky, waiting for CPI, waiting for the Fed interest rate decision in, or I should say on September 20th. But so far, legends, we have a bullish cross on the PPO for the 50-day breadth. Usually, guys, these mark the beginning of an uptrend in the market. And so we do have potentially the beginnings of a choppy beginnings of a new uptrend happening as we speak right now. But it is occurring in a bearish, seasonally bearish, or I should say seasonally weak time of the year, that is September and October. But after October, legends, I think all bets are off. The market should see some very nice moves. And also, guys, 50-day moving average, low, higher, low, higher, low, higher, low. We're still making higher low on breadth. And so to my eyes, it looks like the market is looking for the end of this pullback. It is looking to rally. It is leaning slightly bullish heading into CPI. CPI still remains huge. It still remains very important. Even if we get a big sell-off post CPI, I think we'll still see a bounce after that, especially at the end of September. So last 10 trading days of September tend to be very difficult, but at the end of September, beginning of October, we tend to see some nice rallies. Now, let's take a look at the Fear and Greed Index. Again, look at this, legends. Fear and Greed Index making low, higher low, higher low. Still making higher lows. It is slightly trending up, trying to crawl its way out of this hole. And the major really indicator that I want to talk about in the Fear and Greed Index is market volatility. What do you guys remember? Anytime we're above the 50-day moving average, this is the orange line. Anytime we're above it, the market is selling off. It is trending down. Whenever we are below it, the market is rallying. Whenever we're below it, the market is rallying. Recently, we had a break above. We had that sell-off to mark the end of July. All of August basically negative, very weak. Recently, we broke below the 50. We tried to take it back last week at the end of the week, and we failed. 3 times the bears tried to break above the 50-day, failed once, twice, 3 times. The 3rd time we took out these lows. And just from looking at this, legends, the VIX does look weak. It does look like it wants to keep going lower, at least to fill the gap at 13. And that opens the door for upside, and it tilts the playing field towards the bulls. Just a quick reminder, legends, if you don't want to miss any of my analysis, all of my trades, investments, and you want to have access to all of my trade setups that I share pretty much every day in the trading community, check out our Patreon page. We do have a 70% discount on the annual membership. Please make sure to click pay annually if you want to go for the annual membership. If you want to go for the monthly membership instead, that 54% discount is still available. Just click join. Again, annually, click pay annually. If you want to do monthly, just go with the monthly membership. Thank you so much, legends, for your incredible, legendary support. You have built this channel up to what it is today. You legends are what drives me to put out these videos, to share all of this stuff with you as much as I can, as many times as I can, and as often as I can. If you enjoyed this video, slap that like button right in the face. Subscribe if you haven't yet, so you don't miss any videos, because my upload schedule has been slightly more sporadic recently. So you absolutely need to subscribe so you don't miss any videos. And if you watched till the end and you did not enjoy the video, I do thank you for your time and attention. That's all I have for you today, legends. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow.